Yes, they started the show already? I think it's not supposed to start for another minute. I was just cleaning this office. It's a terrible mess. Well, I see that there are many attendees here. I recommend that you turn your sound off or maybe listen to some Pink Floyd, maybe Dark Side of the Moon, because that's pretty much what you're going to get here. Alan is grasping for straws once again, trying to think of things that may be hot or maybe not. By the way, there's a lady in Connecticut with a cat. Your cat is scratching the screen. That's probably not a good idea. Meow. Okay, so I hope you've warmed up sufficiently to be ready for what will certainly be a disappointing show, especially if you want to learn about estate planning, estate tax planning, creditor protection planning, taxation, or puppetry. So here comes Alan, and again, the management apologizes for this presentation in advance.
Well, hey, Mildred, how are you doing?
Oh, great. I was just telling him how great you are.
Oh, super. Thanks for always being there for me. We'll give you a round of applause.
Well, thank you very much. I hope you don't blow this show again.
All right, well, welcome to Saturday. I'm sorry you didn't have anything better to do. Today's presentation is called Hot Topics for a Hot Summer, but I'm pleased to tell you that in Florida right now, it's only in the 80s, not in the 90s. So the alligators don't have to come out of the water as often as they would have. We have some interesting topics, nothing particularly hot, besides the fact that Joe Manchin is not going to allow the Democrats to launch a new tax law. That's fairly recent, just from yesterday, and that certainly pleases me. I won't have to learn about a lot of possible tax laws because the bill apparently is not going to come out. The second thing that's hot for those of you who are estate tax planners and prepare estate tax returns is the recent IRS proposed, or the actual revenue announcement, revenue procedure that just came out, which says that if your spouse has passed away and the gross assets of your spouse did not exceed the $12,060,000 exemption amount, then you have up to 5 years to file an estate tax return to take over your spouse's exemption. So in other words, if your spouse made $1 million of gifts during his lifetime, now his exemption is $11,060,000. He died. He left you all of the assets. Your exemption is $12,060,000 plus his unused $11,060,000 for a total of $23,120,000. But only if you file a timely estate tax return claiming the portability allowance. So that was a 2-year deadline, and the IRS was really busy answering inquiries from taxpayers asking for permission to file late for all various reasons, and finally just gave themselves a 3-year break, because that estate tax return for portability allowance will not have to be filed until 5 years after death. So if you are a CPA or a law firm like us, who have been working on some of these tax returns that are due just in a few days, now they are due in 3 years and just a few days. And while it makes great sense for me as a professional, that's a cash register, to get that return done as soon as possible, while all the information is timely, well, in 5 years, maybe it will be determined that there was no portability allowance needed because the surviving spouse may die within 5 years, and then you would know whether he or she is underneath the $12,060,000 allowance or whatever that allowance will be at the time. Maybe the estate tax will be eliminated. I doubt that, but that is a very, very nice give me from the IRS, very generous on their part. So I will just thank them for that. Another hot topic for estate planners and estate tax planners is what's going on with all these derivative forms of Bitcoin. Bitcoin was up to $60,000 a coin, dove down to 18. Now it's at about 20,000 a coin. But a lot of people invested not directly in Bitcoin, but in Bitcoin platforms. And these Bitcoin platforms don't have the cash to pay the investors. So if the Bitcoin platforms are actually holding the Bitcoin or whatever derivative form of that it is, if they actually have it, then hopefully they will eventually be unfrozen. But by the time they unfreeze, Bitcoin and the derivatives may be at 1/3 to 1/2, 1/4 of what they're at now. So by means of example, which is a common example, someone put $5 million into Bitcoin when it was at about 10,000. It went to 80,000. They had $40 million worth of Bitcoin. Now they put that Bitcoin into an LLC when it was worth 80 million. They sold a 99% non-voting member interest in that LLC to a trust for their children for $56 million. Now that trust owes them $56 million, and the trust has Bitcoin that's worth $20 million. So that's going to push that estate tax plan upside down, and the people may wait, and probably should wait, to see if it comes back up, or there may be a way to divide their trust into two separate trusts or otherwise take action. On the other hand, if the client is very confident that the platform is frozen but coming back and wants to avoid estate tax, then I can put that frozen interest that's now subject to a bankruptcy proceeding into an LLC by preparing a nominee agreement and assignment. Even if the platform does not allow transfers, I can get that LLC interest valued very low by a realistic appraisal firm, and then I can transfer it as a gift at that low value or as a sale for a note at that low value into an irrevocable dynasty trust. So let's say the client had 80 million worth of a lithium, and now it's worth 20 million, but it's frozen. Maybe it's only worth 6 million now. I tell you, I would not pay someone 6 million for 20 million worth of frozen lithium. So now I sell it to a trust for 6 million. If the client's premonition is right, that it comes back up to 20 million or 30 million, then I've gotten tens of thousands of dollars out of the client's estate for federal estate tax purposes. The other thing that's hot is going to be how many small businesses, how many investment houses, and how many borrowers fail now because of this Bitcoin crisis. Many of the people who were inclined to put $2 or $3 million into Bitcoin were also inclined to leverage themselves, borrow a lot of money, buy big houses, buy nice commercial real estate, buy cars. And because they wanted to put as much as they could into the Bitcoin or the derivative of Bitcoin, they went into a lot of debt on the other assets. And now they can't pay the debt, they can't make the capital calls, they're afraid of what's going to happen. They may move to Florida and put their remaining assets into a homestead. So that's going on. It's going to cause a little bit of buckling of the economy. It's going to surprise some small businesses. This is the type of thing that happens when a Ponzi scheme happens. And I think we're going to find that some of these frozen derivative companies turned out to be Ponzi schemes. Things were going so well. Why don't I just take the investors' 40 million and keep it in cash or spend it? And then suddenly Bitcoin went up. I didn't really buy the Bitcoin, so now I'm hiding the problem. And now I can't even get the Bitcoin I was going to get, and it's all frozen, and people are going to go to jail, and that just seems to be the American way. So I always tell clients to be very careful of who they do business with. And I think the Bitcoin, when it was advertised during the Super Bowl, I knew it had gone a bit too far. Okay, so that is a little bit of a hot topic. Another hot topic is how the interest rates are going up and inflation is happening. In the meantime, the stock market took a healthy dip into a bear market. So as an estate planner who's been involved with estate planning since 1983, and as an investor who has been involved with low-cost, efficient mutual funds since 1987, I feel confident that the stock market does not go like this. It goes like this. And the one nice thing about it, from my experience and from everything I've read, is when it goes down, it's always come back up. If you're in a broad allocation, it's always come back up and beat where it was before within 5 years, since I've been watching it in the early 1980s. So there are two types of investors. The first type of investor is the investor like me and most of my clients who I know fairly well because we've had the conversation. And when the market goes down, what do? You stay in. You stay in because within 5 to 6 years, it's coming back up, and you don't know what day it's coming back up. And as a friend of mine, Randy Lose, once said, the market timing hall of fame is an empty room. No one in the history of investments has ever been able to predict when the market is going to go up or when the market is going to go down. And you have a lot of investment advisors out there who believe they know when the market will go up or when the market will go down. And maybe they were lucky 2 or 3 times. But if you read Wall Street Journal articles about the market the day before, every time the market goes way up or every time the market goes way down, you'll see that they don't have a clue. None of us know. So the best advice you can get from your investment advisor is stay generally allocated so that if there's a failure of one stock or one industry, you won't be decimated. There's plenty of different stocks and plenty of different industries. You can spread it around. And secondly, don't try to time the market. Now would be a better time to put some cash into the market than 6 weeks ago when it was maybe artificially high. So studies have shown that the average investor who stays in with good advice and low costs earns about 8% a year on average. And the average investor who tries to time the market earns somewhere between -2 and +2% on average. And that's when they're advised by all these really smart people who know all these ways to when the market's going to go down. So yes, it's fine to have a portion of your investments in bond funds, and Marcia and I certainly do, and our well-advised clients, I think, certainly do. But are you more concerned and afraid about inflation, which will definitely take away the value of your dollar to the tune of 67% a year right now? Or are you more concerned about the stock market, which has on average returned well above inflation. So, or maybe you're more comfortable with real estate. A lot of times the issue with real estate is it sounds great until the 15th time that the tenant has called you, the roof keeps leaking, it keeps breaking, the tenant trips and falls. But I have noticed that my real estate investment trust account, my one real estate investment trust holding at Vanguard, has averaged 10.1% a year over the last 10 years. And I have never had to talk to a tenant or fix a roof because the real estate investment trust that Vanguard invested in took care of all that. I'm not trying to endorse Vanguard. I'm not trying to give investment advice because I'm not licensed to give investment advice. I'm not paid to give investment advice, but this is a good time to think about what to invest in and to do it very cautiously. I do recommend educating yourself, keeping the cost down, and not trying to hit home runs. We tell our doctor clients, those clients who swing for the home runs and invest in all these neat little sexy scientific companies, usually lose most of what they invest. Whereas the S&P 500 and the NASDAQ have much better track records. Okay. The next thing I wanted to mention is the Spousal Limited Access Trust. And by the way, I will have slides later today, maybe slides in the family stone, but a change of pace isn't bad, is it? So the Spousal Limited Access Trust is a trust that I can form for my spouse, and I'm the grantor of the trust, so I'm the one who puts the assets into the trust, and my spouse is the beneficiary of the trust, and my spouse may be the trustee of the trust. And as long as I put the assets into the trust, they're not my spouse's assets, they're my spouse's. I mean, they're my assets. And my spouse is the trustee, but is limited to receiving no more than what she needs for her health, education, maintenance, and support. Those are magic words in the tax law. They date back to the common law of England. Then that trust, those assets in that trust are out of my estate for federal estate tax purposes and not in her estate for federal estate tax purposes. My creditors cannot reach that trust because I'm not a beneficiary of the trust, and her creditors cannot reach the trust because she is not the grantor of the trust, and her withdrawal power is limited to what's needed for health, education, maintenance, and support. And I believe that's the way it works in all 50 states. It certainly works that way in every state that I've reviewed. Now, this trust can be disregarded for federal income tax purposes so that I can pay all the income tax caused by the income of this trust to get my estate even lower. And then a lot of people say, well, what happens if you get divorced? And the answer to that is Marcia would murder me. But the second answer is the trust can divide into two separate trusts in the event of a divorce. One trust would be a continuation of the trust for Marcia. It would be controlled by her. And one trust may be controlled by me for our common descendants. And I could borrow from that trust. Or if that trust is formed in one of the asset protection jurisdictions, and I believe that the safe ones are Delaware, I'm sorry, the safe ones, not Delaware necessarily. Safe ones are Alaska, Nevada, and South Dakota. Then I might be added back as a beneficiary of that trust if my net worth ever goes down precipitously. It rains a lot in Florida, so you never know when you're going to get precipitated on. So that is the SLAT. And we see many problems with SLATs Jonathan Blotmacher and Marty Shinkman and I just published an article in the Bloomberg B&A EGT journal, they call it, the State and Trust Journal. If you want a copy of it, please let me know. And we called it Time Bombs and Strategies for Slats. Because when you set your slat up, you may inadvertently cause federal estate tax. One reason for that may be that if at the top, if Marcia has set up a trust for my benefit and I set up a trust for her benefit, those would be called reciprocal slats. And there's a U.S. Supreme Court case called U.S. v. Grace, where the U.S. Supreme Court gracefully said you can have reciprocal slats without causing estate tax inclusion if they are different enough. Now, it doesn't help if they're different sizes. So size doesn't matter. But according to the U.S. v. Grace case, and later the case called Levy, if they're sufficiently different, then Internal Revenue Code section 2036A1 doesn't apply. So I'm not considered to have set up a trust for myself, and Marcia set up a trust for herself under section 2036A1. But here's the Achilles heel for a reciprocal slat. If I set up a trust for Marcia and Marcia sets up a trust for me, then under the creditor law, I'm considered to have set up a trust for me and Marcia's considered to set up a trust for her. And if our creditors can reach into the slats, then I can throw a big party, not pay the bill, and have it paid by my trust, and therefore the IRS will include that trust in my estate. And the Supreme Court didn't recognize that. The IRS did not argue that in their appellate briefs in front of the Supreme Court or in the Levy case. So if you have a reciprocal slat and it's not in an asset protection jurisdiction, my recommendation is that you move it there as soon as you can. Now, first, continue watching this fine presentation. Don't do it right away.
Not such a good presentation, Al.
Okay, I get it. But eventually, you're going to want to move that slat to an asset protection jurisdiction more than 3 years before the client's death. Here is a second slat issue. If I put this slat in Florida, then under the Florida statute and the statutes of 10 other states, and this is in the article, I can become a beneficiary of that trust after the death of my spouse. Now, that'll never happen for me because I will not outlive Marcia. She has a long longevity. So, but if I do a Florida slat, then I am considered to be a beneficiary under Florida law, even though I can't receive a benefit until after Marcia's death. And Florida has an exception creditor statute, which says that if I'm a beneficiary of the trust ever, then if I don't pay alimony or child support or bills to a law firm who renders services relating to that trust, then they can reach into the trust. And therefore, I am a beneficiary of the trust. And therefore, the IRS may say that that trust should be included in my estate for federal estate tax purposes. So what do I do? And the answer to that, which we have in the article, is you form an ECT trust. Now, what is an ECT trust? An ECT trust is an exception creditor trust. So for example, if I'm going to put $10 million into a slat, and I'm going to be the beneficiary of the slat after the death of my spouse, I will put $500,000 into one slat And the language of that slat will say that this slat will pay any exception creditor ever owed by Alan during his lifetime, so that no other trust would need to pay an exception creditor. Then I'm going to put the other $9,500,000 in a separate slat, which is going to say that if and when an exception creditor would ever be able to reach into this slat, Alan will never be a beneficiary from that moment on. So now the IRS looks at it. They go, well, you may be an owner for estate tax purposes of the 500 slat. All right. Well, if I had an exception creditor, certainly child support, lawyer fees, support fees are not going to hit $500,000 anytime soon. If I start getting bills for those things and I don't pay them, the $500,000 slat will pay them. But the $9,500,000 slat will never pay them because it's programmed to evict me from being a beneficiary if I ever have an unsatisfied exception creditor. And we have the same trustee for both slats. So that's hot for me because it's a recent thing I wrote about, kind of made it up from scratch. I was hoping Marty and Jonathan wouldn't wouldn't say that's a terrible idea. I thank them for not saying that, at least in public. That is a second issue with the spousal limited access trust. There are other issues and other strategies to consider. A third issue, which will be in part 2 of our article, is whether you can actually toggle off grantor trust status with a slat because of the repeal of Internal Revenue Code section 682. And I know how exciting of a topic that is for you. You'll just have to wait for later when we get that going. The next hot topic that I want to talk about is the increase in interest rates and the ability to loan money to trust for your descendants or other people that you love at just over 3% on a promissory note that could be for your life expectancy. So if you're 60 years old, you have a 25-year life expectancy, you could loan money or sell an asset to a trust in exchange for a note. And when the interest rates go up to 12 to 14%, which is certainly possible. When I graduated from law school in 1984, I believe that the prime interest rate was 12%. It got up to 17%. Inflation was 8 or 9%, as I think I recall. So, you know, what's going on in this country with inflation is nothing new. I remember when I was in middle school that President Nixon passed the price freeze law, that retailers were not allowed to increase prices of anything. And that was how Richard Nixon was fighting inflation. So this is nothing new. And, you know, the inflation will go up. Social Security payments will go up by a portion of inflation. The estate tax exemption will go up, but only by a portion of inflation because the estate tax exemption grows with what they call chained inflation, which is usually about 2/3 of actual inflation. Investments will go up on average. So we'll just have to understand that we were really blessed with low inflation and low interest rates for a great number of years. That may be over, but life will continue. My computer, and I will now share with you a new spreadsheet. I thought of it. This is a client. She has about a $12 million net worth. She is age 70. She spends about $800,000 a year in taxes, insurances, living expenses, and charity. She would like to be able to continue to spend those dollars, even though she's formed a trust that can take care of her family and charity. So it's important that when you form irrevocable trusts, that they benefit charity. Even if the client is not charitable now, they may become charitable later, so they may want to have that door open. Like I said, she has about a 3% rate of return, and she set up a trust for her descendants. So here's the situation. She's got 12 million, growing at 3%, it'll add 360,000. She is owed a note from a trust, which is paying her 441,000 a year in interest. Actually, let me see here, note. Sorry about that. She is owed a note of 4,659,000, which is paying her interest of 79,000 a year, and will give her a payment when it balloons in 2036 of 4,859,000. She takes out 800,000 a year, and the trust that she set up for her descendants owes her 4,580,000. Her total estate is here. Her estate tax exemption is here and assumes that it will go down in half in 2026. Therefore, her estate tax, depending upon the year that she dies, is in red here, and her net estate is here. So the trust was about to sell a business and receive a large capital gain, which would have brought her net worth down to $10 million, because it's $2 million of taxes she has to pay. So she said, let's toggle off grantor trust status and have the trust pay the tax. And we said, no, it's not such a bad thing to have a $10 million net worth, but she was afraid she would run out of money. And you know what? She was right. If she kept spending $800,000 a year and she only earned 3%, she would have run out of money at age 94. And her mother is well past age 94, and the client is healthy. So, but on the other hand, we had to point out to her, if you do this and you end up back at, you end up back at 12 million. I have to type this myself. That's hard work. Then look at your estate tax exposure. You have a lot of estate tax exposure if you die early. So what we did was we said, let's convert, or let's just know that we can convert this promissory note to a private annuity. So the way a private annuity works is that instead of getting paid $79,000 a year with a final payment of $4.6 million, she could agree to exchange that for a right to receive annual equal payments for the rest of her life based upon the IRS tables. So we went to the IRS tables, and what we found was that she could swap that note for a payment for life of $441,000 a year. And if she received $441,000 a year, her estate tax would be greater, but she would not run out of assets. And she doesn't have to do that this year. She could do it next year, and the payments would be higher, or the year after the payments would be higher, the year after the payments would be higher. So she was comfortable with that, staying with the 12 million. Now, the other thing, though, that we were able to tell her is, look, right now, your personal expenses are 500, and the expenses for family and charity are 300. So we could just have the trust start paying the expenses for family and charity. So there we go now with annual spending of 500, and you see that the estate stays quite healthy. So there's a lot of variables here, and I'll be glad to send you this spreadsheet if you just email me. And what I really like about how these spreadsheets have up and down buttons. So, but my gosh, look, if she starts earning 7%, which would not be unusual or unexpected, even if she's spending 800,000 a year, she's going to have, and she's getting a nice annuity, she's going to have a significant estate. So the moral of the story is sell more assets to the irrevocable trust in exchange for a note, and don't overlook the ability to use a private annuity, because when you die, the private annuity is not in your estate. So that would take the note, basically the amount of the note would come out of her estate. If she lives past her life expectancy, then she's going to pay more estate tax because she got more than the note. But if she dies early, then there would be no estate tax. So that takes care of that chart. So now going into the PowerPoint, and by the way, I forgot to tell you that we continue this Saturday series, whether you like it or not. And next Saturday, and CPAs will be able to get continuing education credit next Saturday, the Maui Mastermind Members Guide to Business and Estate Planning Law. Maui Mastermind is a wonderful organization operated by David Finkel, who is a brilliant, brilliant coach and advisor. And David has allowed me to present to Maui Mastermind members many times, so I give him tribute by using his business name in my presentation without paying him a royalty. And then August 6th, we're going to be talking about running numbers on estate and charitable planning techniques, real situations, and silly puppets. And August 13th, we're going to talk about the fundamentals of estate tax planning. All right. Our recent Thursday report, our Thursday report used to come out every Thursday. Now it comes out this Thursday or that Thursday. You never know. I want to mention the Kearney patch. If you are a financial advisor anywhere in the United States, I want you to be aware of the Daly case, where Merrill Lynch, in their margin agreements, said, if you borrow from us on margin, you hereby pledge any of your investment accounts. Well, the language was broad enough to include IRAs. So the IRS went after Mr. Daly because he borrowed money from Merrill Lynch and said, your IRA was disqualified, and on the day you signed your loan agreement, you have to pay income tax on your IRA plus the 10% excise tax because you weren't 59.5. But Mr. Daly had never drawn on the line of credit, so the tax court cut him a break. Well, Mr. Kearney borrowed money from his son's company and signed a typical, what we call a blanket UCC financing statement, which says, I hereby pledge all my accounts, whatever those accounts are. Well, he paid his son in full, and then another financial institution sued him, and the other financial institution said, guess what? We're taking your IRA. And Kearney said, no, you can't. It's exempt from creditors under Florida law. And the creditor said, no, because when you borrowed that money from your son, you disqualified the income tax exemption of that IRA, and your Florida statute requires an IRA to be compliant with the income tax laws in order to be creditor protected. So the bankruptcy court took Mr. Kearney's IRA away, and then that was confirmed by the federal district court, and then that decision was confirmed by the 11th Circuit Court of Appeals. Now, it was an unpublished decision, so it is not precedential, but it is persuasive. There's a big argument in Florida as to whether the case was properly decided because of the vague language in the UCC financing statement. But when you read the language carefully, you can conclude that the bankruptcy court was correct. So the tax section of the Florida Bar, along with many other sections of the Florida Bar, promulgated a proposed law that would have taken care of this to not disqualify IRAs that have been liened in this manner. And because of constitutional issues, Governor DeSanto vetoed it. So next year they're going to try to do it again. But for you people out there with IRAs, when you sign loan agreements, you need to make sure there's nothing in the loan agreement that would cause your IRA to be considered to be pledged. And for you advisors who set up these blanket UCCs and blanket security agreements, you've got to read them because they can be very hazardous to your financial health. Another thing that we reported in the Thursday report, and by the way, if you ever want to research just about anything, just Google Gassman Thursday report, Florida homestead or Florida 10% cap or federal estate tax, and all these Thursday reports come up. So the IRS issued proposed regulations recently, which says that when a person dies and there's debts that are not going to be paid within 3 years of death, or expenses that are not going to be incurred within 3 years of death, you discount that liability on the estate tax return. You can't deduct the whole amount. You have to discount it based on present values. So that was an interesting proposed regulation. I have not yet studied that regulation, but we'll be looking at it pretty soon. And then Article 4, very interesting article, TBE, Your Paramour and Me. A gentleman, I don't think his wife thought he was a gentleman, gave a couple of $1 million worth of joint assets to a professional entertainer to pay her for remaining in a friendship with him. And it was tenancy by the entirety's assets, which were not within his power to transfer because tenancy by the entireties requires a joint transfer. So even though the court said in a very interesting opinion that she did earn it and deserved to keep the fair market value of her services, the appellate court said, no, you've got to give it back because he was not able to transfer this tenancy by the entirety's property. And what was interesting to me is the husband and his wife had an agreement, a written agreement of exactly what the surviving spouse was supposed to do with the tenancy by the entirety's property, which in my opinion caused the tenancy by the entirety's property to not qualify as tenancy by the entirety's property. But the appellate court didn't notice that law. The people who appealed the decision on behalf of the paramour did not notice that law. So this may change tenancy by the entirety's law. It may not. Who knows? All right. By the way, at the end of this presentation, in about 10 minutes, my friend Luis Silva is going to, we're going to play a video that he prepared for Latin American U.S. clients who speak Spanish to understand the U.S. estate planning system. He and I did a video that you can see on our YouTube channel on what U.S. estate planners need to know when you do estate planning for Latin American families. And today we're going to play the new video he did in Spanish for the Latin American families. So I hope you enjoy that, especially if you don't speak Spanish. Maybe if you play it slower, it'll make more sense. All right. So let's see what else we've got here. I wanted to mention a few estate tax tactics that many of us just don't think about, and certainly many of our clients don't know what they are.
Okay, good. What are they?
Okay. Number one, divert business opportunities and income to the next generation. So one idea is, should you sell your Lithium Bitcoin account to your child? Or if you know how to set up tire stores, gosh, are you good at setting up tire stores? Do what Sam Walton did on Walmart. He didn't own his stores. He set up partnerships. He was the 1% general partner, and his children were the limited 99% limited partners. So he never owned the stores in the first place. When he died, the estate tax was much lower than it would have been, which is why his survivors are always on the Forbes list of the most wealthy Americans. If he had not done that, then they would not be on that list. So divert business opportunities and divert businesses. A second thing is what I call a Russian roulette buy-sell agreement. The Treasury regulations and Internal Revenue Code section 2702 say that when you die, if your stock or your ownership interest in an entity is subject to a binding buy-sell agreement, which uses a valuation method that is somewhat prevalent in the industry, then that can set the estate tax value. So if I have a very successful roofing company with my children, and I want to keep ownership of the roofing company, then what I can do is ask an appraiser to tell me a method of appraisal that is conservative and somewhat prevalent in my industry, but not necessarily gets to the highest value. So I call that a Russian roulette agreement. Now, if it's an unrelated party in the agreement, then you can use a low value as long as it's not for the purpose of avoiding estate tax. And what you can do on the side, having nothing to do with the paramour, is you can have the company fund large life insurance policies on each other. So let's say we have a company that could be worth 20 million, it might only be worth 10. Depends on how you look at it. So we do a buy-sell agreement. The strike price is 10. If one of us dies, the survivor gets 5. But in the meantime, the company also advances money to life insurance trusts, so we each get $10 million worth of life insurance in an estate tax-free life insurance trust. So now I die, my survivors pay estate tax on 5 million, and they get 10 million estate tax-free. That's a lot better than paying estate tax on 10 million and only having the 6 million that's left over. So I like to call that a Russian roulette, but reasonable buy-sell agreement. Number 4, another hot topic, just because it's a disappointment. If I fund a life insurance policy for a life insurance trust by advancing money under the split dollar regulations, and the split dollar agreement, which is drafted exactly pursuant to the regulations, say that the agreement can be amended by unanimous consent of me and the life insurance trust, then under Internal Revenue Code section 2036A2, I am considered to have retained an interest in that life insurance policy pursuant to the Levine case and the Cahill case, which come from the Powell case. So what you need to do 3 years before death is amend that split dollar agreement and be silent on what it takes to amend it. If you're silent on what it takes to amend it, then under state law, you can still amend it. But the tax court case, which derives from, I believe, a U.S. Supreme Court case, is if it's a right that you have because of state law, then it's okay. But if it's a right that you retain contractually, then it is not okay. So that I found to be of great interest. Okay, all right. I'm going to also mention that your bonus estate tax exemption, which gives you presently a 12 million exemption instead of a 6 million exemption, expires in 2026. So the exemption goes down to half. But your GST exemption, which allows you to leave assets into trusts that can benefit your descendants without being subject to estate tax at their level, and your portability allowance do not go down in 2026. So although many clients are not going to want to give a $12 million gift to use the whole allowance, they could make a transfer to a grantor retained income trust. Thought I had one here. Make a transfer to the grantor retained income trust. I put $12 million in a grantor retained income trust. It pays me income for my lifetime. I use my $12 million exemption, and let's say it's worth $14 million when I die in 2027. Well, the whole 14 million is going to be in my estate. I'm only going to have the benefit of the 7 million exemption if the exemption's 14 when I die. But that 14 million in that grantor retained income trust can benefit my descendants without ever being taxed in their estates, so it uses my GST exemption. And if I had a $12 million portability allowance and I put 12 million in the GRAT to use my portability allowance, and then I remarry and my new spouse dies before me and I would have lost my portability allowance, it is still all there in the GRAT, in the GRID. So we do have until 2025 to get these things in, to get them moving, but it's going to take us estate planners until 2025 to get our heads around these concepts. So I think it's a hot concept now. The other thing that's affected is that I can give a gift based upon a note to my descendants or to a dynasty trust, which is called an unsatisfied enforceable promise to pay. But if I do that, it will be subject to the same clawback regulation unless I pay the note in full more than 18 months before my death. So there are a lot of taxpayers out there who owe large notes, and you may want to think about getting them paid. Just use bank financing or whatever it takes to get the note paid more than 18 months before January 1, 2026, so you don't have to worry about the 18-month exception. All right, well, that ends my presentation of hot topics for a hot summer. Thank you very much for attending. I hope it wasn't too bad. Now we're going to play the video by Louise. And if you have any questions, comments, or suggestions on this, please send your comments in Spanish to agassman@gassmanpa.com.
Hola, everybody. Hola.
Thank you very much, and have a wonderful rest of your weekend.